We're closing out the year with compressed liquidity and elevated macro noise. Headlines are active, but price confirmation remains selective. Structure still comes first. Index levels look strong on the surface, but participation underneath remains uneven. That divergence matters more than the headlines, especially in holiday conditions where volume is thin and signals can distort quickly. On the macro side, attention is shifting toward the long-term relationship between the Treasury and the Federal Reserve. Treasury Secretary Scott Bessent is signaling interest in redefining how monetary policy interacts with the broader government framework. This is less about immediate rate relief and more about authority and coordination over time. That theme is reinforced by public messaging from Donald Trump, where monetary outcomes are increasingly framed through a political lens. Even without near-term policy changes, tone matters for longer-term expectations and risk pricing. The broader implication is tighter coordination between fiscal and monetary arms. Balance sheet tools like QE and QT would become conditional rather than routine, reserved for stress instead of normalization. That would mark a meaningful departure from the playbook markets have relied on for years. At the same time, AI leadership is back under scrutiny. Michael Burry has re-entered the conversation, framing current AI enthusiasm as increasingly similar to prior speculative cycles. His focus isn't dismissing the technology, but questioning capital concentration, earnings durability, and second-order risks that tend to emerge later in adoption curves. That skepticism shows up in disclosed downside exposure to NVIDIA and Palantir. The concerns center on margin sustainability, customer funding dynamics, and long-term competitive pressure. NVIDIA has rejected those claims, reiterating confidence in demand and accounting practices while continuing to deploy capital aggressively. Recent investment tied to inference performance highlights where the next phase of AI competition may shift as workloads move from development into deployment. Valuation debates persist, but capital spending has not slowed. From a policy standpoint, central banks remain out of sync with markets. Jerome Powell continues to emphasize patience, while futures pricing has cooled on aggressive near-term cuts. The gap between guidance and expectations remains, even if it has narrowed. In the tape, holiday trading limits signal quality, but SPY pressing to record highs still matters. What matters more is whether price can accept above those levels. The Nasdaq continues to lag. QQQ remains capped beneath declining highs, while the Dow and S&P have already resolved higher. Broad confirmation requires alignment, not isolated strength. Some software-related groups improved late in December, but follow-through remains the burden of proof. Looking ahead, the calendar includes pending home sales, FOMC minutes, jobless claims, Chicago PMI, and end-of-week manufacturing data alongside balance sheet updates. Even in a holiday week, these events shape expectations. Rotation remains selective. Materials are constructive, but sentiment is heating up. Many metals names are consolidating rather than extending, favoring conditional entries over anticipation. Steel and copper continue to see steady inflows, while some lagging names still require digestion. Financials continue to show stacked order flow across several asset management and banking names. Recent pullbacks were deeper than ideal in spots, but structure remains intact near potential resolution zones. Technology remains unresolved. Until QQQ confirms higher highs, selectivity and patience matter. The takeaway is preparation, not prediction. Index highs only matter if participation broadens. Until that happens, discipline comes from waiting for confirmation and respecting structure. If you enjoyed today's market insights, consider joining the free Zen Trader newsletter. Link in the description.